Good day, Sanbona. Today I'm with Paul Mojalefa from the ECIC, which is the Export Credits Insurance Corporation, a state-owned enterprise. And today he's going to be unpacking the products that they have available for enterprises, South African enterprises wanting to invest and tap into spaces, be it in the neighboring countries or as far as European countries. So Paul today will be unpacking it and just giving us a bit more information. Just to also introduce him properly, Paul is a deal originator under the business development unit under the ECIC. So, Brother Paul, thank you very much for availing yourself today.
Thank you. Good morning, Mr. Langa, together with your members and your listeners.
So, no, thank you, brother. We highly appreciate it. So I believe you do have a slide for us that you are going to be presenting today. And, at the end of the slide, our viewers can also get the slide on our website, and we will have questions at the end. So, yeah, I'd like to just give it to you to start with the slide and the presentation.
Okay, great. Thank you so much. Right. Okay, great. Thank you. So we can just go to the first slide after this one. Yes. Okay. So we have been around since 1957 as an act, but the establishment came into play in 2001. So the insurance business that we are in was reinsured through the private sector, but we then brought it back in-house in 2001. So we are under the Department of Trade, Industry and Competition, and we conclude insurance contract on behalf of the South African government to lenders and investors who are in either on the lending side, on the export side of capital goods side, and investors who make cross-border equity investments. So our mandate is to facilitate the export trade and cross-border investments between South Africa and the rest of the world. We, of course, being an insurance company, we have some regulators that oversee us. On the monetary side, the Prudential Authority of the Reserve Bank, as well as the Financial Sector Conduct Authority. We conclude our investments in Rand, in the common monetary area, and beyond that, we do it in US dollar. We are now applying to the Reserve Bank to also allow us to keep reserves in euros. So it means that the insured will pay us in dollar, and if there's a claim, we'll pay the claim in dollar or euro. So we have been allowed to keep our reserves offshore. We can go to the next slide where we actually, you can just go to the next slide, 3. Right. So we are the official export credit agency of South Africa. We provide our reason of existence is to provide political and commercial risk insurance to facilitate those exports. I'll come to that in a moment. And us providing cover to the lenders, it then unlocks the availability of finance for the buyers, for these South African export goods and related services. And even though we do not provide lending ourselves, being just an insurer, we work in close collaborations with lending institutions, which are commercial banks, and developmental finance institutions, which are DFIs. We are trying to find a way to also provide cover to non-South African banks, but at the moment, the cover is only to banks that have a license in South Africa. And of course, in the main, the financier is the one who holds the insurance, but there are instances where the exporter themselves finances their own export contracts, which we also consider. Then when we go to the next slide, we are providing a risk mitigation, which then gives, it reduces the next exposure in the event of loss for the insured party. And we fulfill the Basel III requirements of banks where capital banks, commercial banks get capital relief for the exposures they have. So in that way, they can then do more lending on the back of South African exports of capital goods and services. I must also add that we do what is called medium and long-term insurance. So in instances where you have commodities or perishables and all those type of things that get exported, and the payment terms are your 60-day, 90-day, 180-day terms, we are not allowed to play in that space under the act that regulates us. We only look at instances where the minimum contract of export of these capital goods is 2 years and beyond. So when we provide the benefit to the lender, taking the risk onto our shoulders, that helps the lender to give a lower margin than what would ordinarily be charged on the borrower, which then helps the deal to move forward. In the main, our political risk insurance cover would be 100%. I'll come to that in a moment. And commercial risk insurance is 95% maximum. But there are instances where there are select transactions that meet certain criteria called small and medium transactions, where we go for $20 million or below those transactions. We provide 100% political risk insurance and 100% commercial risk insurance. When we go to the next slide, you will see that there are people that come where they're doing bids for international contracts. We can give expression of interest letters when we have sufficient information to do so. So we do that. And we also have parties that come where they have issues like bid bonds or advance payment guarantee or performance guarantee. We can give up to 90% cover to the lender that finances those bonds and guarantees. So we have a model for that. And there are also some exporters that get working capital facilities on the back of an export contract that they have won. We give up to 90% cover on that export contract working capital application to the lender. Initially, it used to be on only the boat builders, but that has now extended to other sectors at the moment. In cases where the contractor finances their own contract, we will expect the repayment for a minimum period of 2 years, maximum 5 years, 60 months. We call that supplier's credit, which means that the exporter themselves become the bank. We allow that also. And it can also be that the exporter can cede that policy that we have given to them to a bank so that they can unlock their balance sheet and their working capital requirements. But in all of this, the exporter must still receive a 15% down payment on the contract that they have won. In the export credit business, there must be a minimum deposit, a minimum down payment of 15%, which must go into the contract, which will be paid by the buyer. And then the 85% will come from the bank, which is the 85% that ECIC will provide cover on. When we go to the next slide, we have a requirement from our shareholder in terms of what is called South African content or African content. So for projects on the African continent, they must meet a minimum of 50% South African content, and then 20% in the host country. So we can say Mozambique, 20% in Mozambique. But if they do not have that content in Mozambique, it could be any other African country, including South Africa. But that content, how we calculate it, is not only the bolts and the nuts that go into building the equipment, minus of course whatever is being imported. It also includes wages and salaries. It includes freight charges. It includes the insurance premium, including the ECIC premium at that, the finance charges that go with the transaction, the fees that are paid to auditors, lawyers, engineers, etc., and any other profits that accrue on the transaction. And that calculation is done on the 85% I've mentioned earlier. This is how you calculate content. When you look at the sectors, we have a cover. We are trying to find projects across the whole spectrum, from equity to long-term debt, sovereign, corporate, project finance, all of that. Mining, gas, power. Your members, Mr. Lang, of course, they are in many sectors. So we urge them, when they have these transactions cross-border, let them come to us. We do not do business in South Africa at all, but if it's cross-border and the transactions have a good track record and your clients have already discussed with banks to finance those transactions cross-border and they meet our criteria, we are happy to have a discussion with them further. or when we go to slide 8, it's now us as insuring banks in the main. We have to adhere to those sustainable policies, anti-bribery, non-disclosure of any agents and fees, because those are the things that our prudential authority wants us to report on, making sure that they meet the environmental standards. And if the borrower is a government, we do not want to burden that economy. We do not want to do white elephants or projects that do not benefit the economy in the long term. So if somebody comes and they say, we want ECIC to look at covering a stadium, it's not really, it's a sporting facility, but I think the government is good at that. You don't want the government to go and raise a loan to build a stadium, for example, rather let them use their money to do it. Or somebody coming and they want to build a convention center. Convention center does not add value other than just people coming for conferences. Those are things that the government can finance on their own instead of raising money outside. Okay, so then the next slide is now the nitty-gritty of what we do. So it must meet those SA content requirements. You will need a minimum of 15% that must be paid to the exporter by the buyer. The 15% is what the 85% is what the bank will then finance. There must be a minimum repayment period of that loan for 2 years to fulfill our requirements, even though there will be exceptions for working capital and bond products. The projects must be creditworthy. The buyer must be creditworthy. They must fulfill all the things without relying on third-party support. So the project must make sense on its own before you look at other buffers that can come on top, the cushions that can come on top to have the transaction move forward. And yes, for investments, which is a standalone policy, this is now where South Africa, a South African registered entity, makes an equity investment cross-border. There's no content required there. We can look at cover up to 15 years. How we make our money is through the premium, so that we charge the insured premium, and there will be an opening. To open the file, there will be what we call assessment fees. They apply upfront, but we in the main, our main bread and butter is the premium. Then on the next slide, we are talking to the premium. We always ask that question. It's not off-the-shelf premium. Every deal that comes through our door, they will have to calculate the premium individually. So what then happens is that the premium is based on the country risk rating, is based on the commercial risk of the transaction, the credit rating of the counterparty, the tenor, the scope of cover. The premium could be paid up front, it could be on an annual basis, or as and when the bank makes the drawdowns. We always make a delineation of the premium and the interest rate paid on the loan. The lender, of course, will monitor the project throughout the life of the loan, which we get quarterly reports on. And any material adverse effects on the project, we know way in advance so that we can act accordingly. We do not wait to go to the end and then something was wrong and then we would have not known. So, but there are instances where we pay a claim, then the lender will assist the ECIC to recover those monies by way of salvages. Then when we go to the next one, it's what is political risk insurance? So political risk insurance would be where there's one civil disturbance while the loan is ongoing. They expropriate or confiscate or nationalize the asset. There is transfer restriction, there's change in law, or they don't honor the sovereign obligations. You also have where the government breaches the contract. I apologize, my dog today, I don't know what's happening, Peggy. I hope it doesn't disturb and then also, on a case by case, we can look at issue of terrorism and piracy. Then commercial risk events are where when the loan is being serviced, the borrower goes insolvent or there's protracted payment default by the borrower. So we cover that, and it can be up to 95%. So that is our bread and butter on that 85%. this is something you can just go through. It's also on our website, the type of countries we're in. We want to change the flavor a bit, but of course, Mozambique is going to be #1 again in the next few months with the LNG projects. We can talk about that later. Then we can go to the next one where, again, the exposure, you can see it's mainly power. It's a lot of power projects in the region, but we also want to take other sectors going forward so that we are not overexposed to one sector. Then the next one is, so these are the products. You can actually go through that. Let me pause here and then take questions from you, because the other slides are really just something that your members can go through and understand what we do